Hello and welcome. The provision of financial service and management of small amounts of money through a range of products targeted at low-income clients is not new in Ghana. Susu, which is one of the microfinance methodologies, is thought to have originated in Nigeria and spread to Ghana in the early 50s. But lately, the microfinance industry has been tainted with stories of clients being swindled of their savings. Just yesterday, there were media reports that more than 100 clients of Essolok Investment Limited, a savings and loans company, have been swindled of thousands of cedis. The company failed to honor its promise of paying 2% interest on savings per month and a refund of returns and deposit after 6 months maturity period. Now, this is just one of many cases across the country. Now the central bank plans to put a ceiling on the number of licenses to be issued, and it has also increased the minimum capital for deposit-taking microfinance institutions to 500,000 Ghana cedis from 100,000. Now, non-deposit-taking firms now require 300,000 Ghana cedis minimum capital. All these, according to Bank of Ghana, are measures to protect the depositors' funds. So why is the regulation of microfinance companies still a big problem for the central bank? What can be done to streamline the industry, to cut back on what appears to be the norm as many companies keep swindling their clients? What is the way forward in sanitizing the microfinance industry in Ghana? And we'll be finding out all these and more right here on PM Express. My name is Nanan Saka. When I come, I will introduce my guest. Well, hello, and the whole topic today is upsurge of scams, narrowing it down to microfinance companies, which seem to have sprung up very much lately, even though it began in the 50s. Now, almost every other shop on the high street, and you see a sign saying, come in for a loan. And with me to discuss this issue is Richard Amening, who is Executive Secretary to the Ghana Association of Microfinance Companies. And maybe later on, Roderick Ayer might join us, running a bit late, a microfinance consultant. But at the moment, Richard, thank you very much for honoring our request and welcome.
Thank you very much, and good evening to your viewers.
To the man on the street, any building that I walk in to put my money in, it's got to bank. So now we hear that, oh, this is not a bank, this is a microfinance, this is a credit facility, this is Susu, this is break it down for us a bit so that we continue, discussion. I mean, what makes a bank, and what makes something, one a microfinance, what will make it?
Thank you very much. When we talk of a microfinance company or institution, it's simply an institution that provides financial services to low-income earners or the unbanked sector within the economy. When you look at the Ghanaian economy, looking at the informal sector, majority of the population are not served by the major banks. But when you look at the banking sector, we're talking about the formal banks that do financial intermediation at a higher level. That is what we're talking about, the commercial bank or the universal bank, referred to as the class 1 banks.
Okay.
Then we have other categories of banks as well. But the microfinance is talking about a small business unit or a limited liability company that provides financial services to those who are not served by the major banks. Yeah.
We're going to take a break, and when we come back, now I'm going to look at the limits within the microfinance, where they can get to and where they can't get to? Is it backed by law or just by economic factors? Stay tuned. Upsurging of scams, and we're narrowing it down to microfinances, and you hear them closing down one after the other, and people depositing their money and losing their money. Now, I just wanted to find out, just before we went to break, if I walked into microfinance, Richard, and I said, look, I have $5 million or CDs, and this is where I want to save it. Can they take it, or by law they're not allowed to take it? What are the regulations?
Right. When you look at the microfinance industry, regulation within the industry came into full force in 2011. And as the regulation came out with certain permissible activities and the guidelines as to the limits and provide direction to the microfinance institution. In 2011, July, the central bank came out with a detailed regulatory requirements for all microfinance institutions within the country to comply with. If you look at the regulatory requirements, there are certain aspects that the Bank of Ghana put in place to guide the microfinance institutions and to also safeguard the interest of the general public or depositors. When you looked at it, there was a component of what we call your startup capital, known as the paid-up capital. Mm-hmm. In 2011, the paid-up capital for a deposit-taking institution, known as a second-tier microfinance institution, was 100,000 Ghana cedi, but was raised in 2011, May 2011, to 500,000. What happened was that when you look at your paid-up capital, you cannot give up to a certain percentage of your paid-up capital to a single person. Okay. There was also a criteria as to how much you can receive from someone who walks into your banking to stay with you. The idea of that is to safeguard the company itself, so that you don't expose the company to certain risks that are inherent and that can also cause the downfall of the company. So the regulation makes it explicit that for a particular person, you cannot accept more than 10% of your paid-up capital as savings from the person.
I thought you couldn't give out 10%.
You couldn't give out 5% for unsecured. 5%. Then for a secured, not more than 10%.
And so, taking into is 10%.
Because we're looking at setting the limit, mm-hmm. so that we don't, if you take up so much from one person, I have my paid-up capital of 500,000. I take 1 million from you. I do the business. If you are coming for your money, it means that it's likely the company will collapse. So the limits are set in there. For such values of money, then you go to a higher level of institution that can take that money. That is how it is for the savings. But if it is for the institution to go and borrow as a debt instrument, then it's allowed for you to borrow, then you operate and you pay back. But as a savings where someone walk into your microfinance institution and say, I'm opening a savings account of 1 million Ghana cedi, then it's not allowed for us to do that. You have to always match how much you can take by your paid-up capital. There are limits within the regulation. If you look at the current regulation that came out, when you are giving a single client unsecured loan, you cannot give more than 5% of your paid-up capital.
Okay.
In the event that we want to reduce the risk exposure, when the loan is secured, the central bank says don't give more than 10% for secured loan. This is to ensure that in the event that the client defaults, then it means that you have 90% with other people elsewhere.
And your paid-up capital, should it be liquid or can it be assets?
The paid-up capital is structured in such a way that you have both in liquid and both in assets. There are ceilings to which you can go. You cannot go more than 25% of your paid-up capital in assets.
Okay.
Yeah, because you are trading with money, mm-hmm. so you need to be liquid. Microfinance business is banking at the grassroots, and if you are operating a financial institution, you ought to be liquid. Mm. So you leverage on your liquid, and you also borrow from the public and do transaction with it. So the paid-up capital is set to ensure that before you come in, you are prepared to do the business of microfinance so that you don't depend on public funds to run your business. In the event that people want their money, then you can't pay the money for them.
Okay. Now, you see, one thing that concerns me or worries me is, I mean, we are saying that this business is not new, started in the 50s. There was a Canadian Catholic missionary who started somewhere up north giving money out. And all throughout, you know, the Susu but all these regulations are 2012, 2011. So it looks as if these businesses have been running for a long time before the regulations are coming in. I don't know if I'm...
Yes, you are right. As you rightly said, if you look at microfinance, when microfinance started, I wasn't born yet. It started in the 50s when some Catholic missionaries up in the northern region started what we refer to as credit union, something to help the poor within the church through on-lending to them and also helping them save something small. It sprang up in other African countries. Now, it has operated during that time up to this time. In the villages, there are individuals who, when there's a funeral within the village, they run to and borrow from. These are all forms of microfinance services that they provide. But microfinance grew to the extent that it became a major issue. So the regulator, which is the Bank of Ghana, had to step in to provide a guideline to protect depositors. We were here when R5 Imperium came into the system, made away with the depositors' funds. So on the basis of this history, the central bank moved in swiftly. It was around 2000, a later part of 2010 and 2011, we saw the emergence of the microfinance companies. Then the small susun growing into bigger forms of susun. So there was a need for the regulator to come in and ensure that everyone falls within the regime of regulation so that we can bring sanity in the activities of microfinance companies.
I mean, I'll come back to microfinance, but could the banks, you know, the high street banks not have opened little outlets and mop up these small businesses, the grassroots businesses? Because they were already regulated.
Yes. When you look at the major or the universal or class 1 banks, the banks dealing with the grassroots, they look at risk. You want to deal with a certain group of persons or certain category of the Ghanaian population that are within the informal sector. Some do not have a formalized business. Others too do not have, let's say, identity cards, utility bills, and some of the requirements for you to operate a bank account. So it makes it very difficult for the banks to go down there. And we also look at the issue of perception of this category of people who are outside the main banking. They perceive the bank to be for certain category of people within.
Let me take an insert here, and then I'll come back and finish your submission. I'll just take an insert on microfinance banking, and then we'll continue.
Financial institutions into microfinance, investments, savings and loans are springing up to provide savings and credit facilities to businesses and individuals at lower rates. Although these institutions are able to provide the central bank's minimum capital requirement of 500,000 Ghana cedis for deposit-taking institutions and 300,000 Ghana cedis for non-deposit-taking firms, sustaining their financial dealings with clients remains a challenge. A number of them are unable to pay back their returns of investments made by their clients. Two of such victims who prefer to be anonymous shared their experience.
Actually, the agreement is that monthly there will be an interest of 10% monthly, and that's for a year, right? But the interest will be given after 6 months. So February will be a year since I invested with a US group of companies. And so when it got to August, I went to them for my 6 months interest, only to be given a check, which I put into my account only for it to bounce. And then they sent me text messages that I should hold on and resubmit the check at a different date, which has still not worked out.
So I got an interest rate of 8% a month for a period of 6 months. So I invested an initial capital of 5,000, hoping that after 6 months, an interest of 2,400 Ghana cedis would add up to 5,000, making 7,000.
Wow. 10% per month, that's like 120% interest per year. Now, I'm yet to find out what business makes such profits, but we will get there. But I just want you to finish up with mopping up the grassroots, which the main street banks won't get there. But before, let me acknowledge Roderick Ayer, who's a microfinance consultant. Has actually written a book, Comprehensive Microfinance in Ghana, Hope for the Poor. And so he's here to give us an insight on it. Roderick, you're welcome.
Thank you.
So I'll just let Richard finish with the risk that the big banks don't want to take.
Yes, exactly. As I said, you have that segment of the informal sector where they want to sit in their comfort zone for you to approach and convince them to save. They are also saving for the purposes of getting credit facilities from the institutions. Most of these low-income earners, when you look at the banking, the criteria for the main banking, they don't meet the criteria. So dealing with them is a challenge. And as I said, the bank look at the risk, going down there, the risk and the cost of going down there. You look at geographical locations in the rural areas, in the remote part of Ghana, where the banks do not have branches. How would they move in there? So you look at the concentration of the big banks, they are all in the cities. So in the districts, who go to deal with them? Beyond the districts, who goes to deal with them? So you will realize that there's a huge gap in terms of our provision of financial services. So people are naturally excluded from the main banking sector because in terms of reach, in terms of access, and in terms of maybe the class, because you have certain segment of the population that perceive banks to be to the educated, for the rich, and also for people within a certain class. So they fear to approach the banks because of the perception. So these are the target clients that the microfinance companies deal with.
Let me bring Roderick in here. Roderick, so do we see taking advantage of this perceived class of people? He lives beyond the district. He's never going to get to any police station to report me. So let me take advantage here.
Thank you very much. I think the interesting dynamics that I have encountered in the setting up the microfinance is that at least about 80% of the people that start don't go in with the intention of scamming anybody. Majority of them purely go in to take advantage of the excluded, financially excluded in the society to do the business. But the truth is that the business of microfinance is very tricky. It's very, very detailed. And if you don't understand the detailed, the scams are only a result of bad operational processes. At least about 80% of them. I mean, let's give a chance. So it is not about taking advantage of them. It's about the entrepreneurial desire of the average Ghanaian who is trying to set up an entity because he heard that somebody went into microfinance and now moved from that level, let's say, to a bigger bank. So there's an opportunity for me to also go through that trend and grow. But along the way, a lot of things happened, and that results in the scam processes. So the truth is that most scams are what I would call the operational scams. It happens and you can't face it. So what they do is that they find their ways out of the community. So the intention is not necessarily to take advantage of people, is to provide service, at a cost. And then some of these things, they come along the way.
So then the regulator comes in here.
Yeah.
Because big banks also go into business to make money, not to swindle anybody, but they manage to stay in business. Exactly. So who's checking these guys so that they are falling off? You're promising somebody 10% a month. Where are you going to invest that money to get maybe 12% return to give him 10? Because you still need to keep a profit.
Yeah. So, I think there's one thing we need to understand, in the sense that the regulator, even doing the major banking regulation, does not cap interest rates, in terms of saying that the regulator does not say that if you pick somebody's investment or deposit, you can pay as much as this. It's a free market. So people peg their rate based on what they are going to see. Mm-hmm. The two problems we have is that we have the problem of the providers and we have the problem of the consumer. The consumer wants an excess of what his investment can give him. So when I come and I say, I'll give you 10%, wow, that's good. Because when you go to the market or to the big banks, you are not going to get 10%. So let me take the risk and put in that 10%. The other part of our problem is that regulation came to meet the progress of microfinance in our country, in the sense that we had several of these people operating before regulation came in. So we would have what we call the post and pre-regulatory, characteristics. And the little observation that I've known is that most of them that are going down are people who were there before regulation, because you are used to certain kind of lifestyle. You are used to certain kind of laxity in your operation. Now the regulator says that we all need to measure up our operation to the standard. That includes building your capacity, building the capacity of your staff to manage your operation. And when that is not done well, the end result is what we have. So we need to manage it carefully. The people who were there before regulation, how are they responding to regulation? What is the dimension of regulation on their operation? How well do they understand what they need to do in order to fit into regulation? So it's important that we put all those things in perspective, and then I'm sure we can find a way out.
I bring Executive Secretary in here because you're talking about regulation. How many groups or entities does the central bank have to regulate? I got 291 registered microfinance companies, but then you have the SUSU, and so together, how many entities have we got?
Yes, well, when you look at regulation, it's broad. We have the internal regulation, known as the self-regulation, and external one, provided by the regulator. When you look at the regulation, it clearly defined the microfinance industry in Ghana. Ghana has the unique microfinance industry globally, because we moved down from the top level down to the grassroots. So the regulation clearly defined 4 major tiers. We have the tier 1, that is the rural banks and savings and loans companies. Tier 2, that is the deposit-taking institution or SUSU companies. Then we have tier 3, financial NGOs. Then we have money lenders. Tier 4, individual SUSU collectors. Those we knew in the olden days. And individual money lenders.
They're also registered.
Exactly. And all these categories of microfinance institutions belongs to network associations. We have associations of rural banks. We have association of microfinance companies, money lenders association, financial NGO associations. But when you look at the regulation, the regulator allowed the tier 4, which is the enterprises, because they are smaller in nature and they form the base in terms of the numbers, to do what we call self-regulation through their association. Then the association acquired a license from Bank of Ghana for the members. But when you look at the third tier and the second tier and the first tier, it is within the jurisdiction of the central bank to issue a license. So the central bank regulates directly second tier microfinance institutions, the third tier, that's the money lenders and the financial NGOs, the rural banks and the savings and loans companies. But for the SUSU, they are regulated through their association. Of course, the regulation makes it mandatory for the other tiers to also belong to an association. So that is how the regulation in Ghana has been structured compared to other countries where their microfinance ends at a savings and loans company level. Yeah.
You see, but all these groups and tiers and break have to end up at Bank of Ghana eventually.
Exactly.
Now, the reason why I was trying to lead this question is, are they staffed enough to monitor all these things, to go right down to Bekwai, to come to Kudikope to see what's happening there?
Yes, as Roderick said, you are operating an industry that existed before you decided to regulate. So in terms of numbers, huge numbers. Now the regulator comes in to regulate and ensure that we sanitize the industry. Now the numbers will have to be dealt with. Capacity at the regulator level becomes an issue because the regulator was focusing on the formal banks. Now we want to look at microfinance. And the microfinance institutions are more than the banks. About, I would say, 300 times the banks. We're talking about 2,000 plus. So you want to regulate this institution. You need capacity in terms of human resource, in terms of other resources to monitor. Because when you move to every area, any corner you move, you will see a microfinance institution. If not a SUSU enterprise, it's a money lender or a SUSU company or a rural bank or a savings and loans company. This needs a lot of capacity to be able to monitor. But 1 year through the regulation, the regulator realized that they had capacity issues, the ability to monitor, even the ability to license the institution because they have to submit applications. You have about 8 core staff who will have to review thousands of applications. It becomes a challenge. So what the regulator has done is to create a different department that will handle just the microfinance institutions and the rural banks so that they can deal with the capacity issue. Of course, there's still a challenge in terms of the human resource because the country is big. You're talking about 2,000 plus institutions and you're talking about, let's say, 10 or 15 or 20 staff. How would they be able to move to all the areas and other things? So what the regulator has also done is to engage the network associations, where the associations are given some role to play in monitoring and also giving some feedback to the regulator, so that together we can bring our strength together and monitor these companies. So that is the approach the regulator is using now because they've realized that capacity is an issue. So they are involving all stakeholders in trying to sanitize the industry.
Let me stay with you. So every quarter, all these 2,000 and so entities have to submit a report to the bank to show them what they are doing on a quarterly basis.
On a quarterly basis, if you are not licensed by the central bank, you don't submit a report because that forms the prudential regulation. So it's only the licensed institutions that are mandated to submit reports. And
so there are institutions that take money and are not reporting to the central bank?
Yes, as I said, when you look at it, depends on the category. If you're a second-tier company that is supposed to be licensed by the central bank, you have submitted application to the central bank for license. You were operating before the regulation came. You are awaiting your license. You can't stop because you were operating before the regulation came in, as Roderick rightly said. So the central bank will have to review your application and give you the license. So while they are reviewing your application, you are still operating. So until you are given a provisional approval, you don't submit a prudential returns to the central bank. It's a difficult situation because of how it all started. You see, it's difficult when everyone is out there and all of a sudden, all of you come into the room and let's lock. You have some who will still be dragging their feet, and the regulator is also looking at the volumes. The same staff will have to sit and review the application, give approval for the license to be issued. The same staff will have to go out there and monitor those that have been issued with license. The same staff will have to also go out there and monitor those who haven't applied. So it's a complex situation.
Roderick, the reason why, again, I'm trying to lead to, so who then insures the money that I'm depositing in this bank? Just in case, even if he didn't intend to swindle me, but, the company goes bust. How do I get my money? I mean, is this money insured? Can I then turn to some other entities and say, look, I'll give my money to him, he's run away, don't pay me? What happens?
Well, that's a very difficult, situation, because even for the regulated microfinance institution, it does not necessarily mean that when they go down, the regulator would have to pay off all the liability. What the regulator only puts in place is that he expects you to say that when you mobilize, let's say, this X amount of money, don't put all in loans. But what you need to do is that put some in soft investments. Let's say 40%, you don't have to touch it. That in the evidence that something happens, then we can use that part of money to necessarily pay for some of the liabilities that would have with the regulator. So it's not entirely to say that the regulator had come in to take care of the liabilities in case the institutions goes down. What I think that needs to be done is we really need to do what we call the client protection educations that we need to tell people how they would have to go about some of these things, what they need to look out, who they can deal with. I think for us, that is where we need to approach the issues from in order to soften some of these issues. I think it's important also to notice that regulating microfinance is very expensive. Very, very expensive. Some, works would put it like 6 times regulating the cost of the traditional institutions, where they are, the numbers and sizes. So we have to find very innovative ways of doing it. I think in my mind, we don't need about 500 of these institutions. So how do we go about it? Can't we do clustering? Can't we do institutions within a jurisdiction coming together to form one entity instead of the smaller institutions all going through, the regulatory framework? So we should look at various ways of approaching this
I'll
this
take
problem.
a break, but I'll come back to you. You see, it's just like if I insure my car and the police stops me. He's not going to say if I crash my car, he pays, but he just wants to make sure that you have insurance just in case.
Yeah.
Can the regulator not come in at that? Stay tuned. Hello, just before we went on the break, I wanted to find out from Roderick if the regulator can sort of be, a somewhat policeman, can stop the bank and say, listen, have you got insurance just in case you go bust? I would, make sure your clients are paid. Roderick, you get stopped by the police all the time. They see your insurance, okay, fine, go. Yeah. Just in case anything happens, you're covered. Can there be that system to, police these entities because of the numbers that are going bust?
Well, I think it will be a bit difficult because that is a market. The regulator itself will not sell the insurance. So the question we need to ask is that would the insurance companies be ready to buy such risk? Considering all the background to microfinance and all, would they be willing to take on those risks? That should also come. And then we also need to find out that once they pick up that risk, what it's going to do is that it's going to add to the cost of the already expensive microfinance loans, because whoever buys that at a cost would by all means find a way passing it on to the client. So it has some kind of a double-edged
Let me push
issue.
again as much as possible. The usury law. We had, one of the clients said that he was promised 10% per month.
Yeah.
So that's 120 per annum. Don't even know why I haven't taken my money there yet. But there's a usury law which should, protect how much interest. Are they using it or?
Let me try to come back to the understanding why people are doing this. One of the key issue is that the microfinance institutions are finding it difficult to raise capital for their businesses because the major banks also don't necessarily understand their operations. So when they go to such banks, they go through like any other customer. The foreign funds that are available for microfinance institutions have not found their way into Ghana because they deal more with sizes and they deal more with systems. We are not coming through. So we have them more in Uganda, east Africa more. But these institutions must survive. And the truth of the matter is that they cannot survive only on deposit mobilization. So they would have to look at creating a product, and that is the outcome of this high interest rate. So that the consideration is that behind the interest rate, it says that I am risky, but I am prepared to give you a higher return on your money than the safest investment in town, whether it's a T-bill or what other banks can give you. That is why we have moved into that direction. But as to saying that we can necessarily peg the interest rates of what an institution can offer in terms of return, I'm yet to really see how that can really work.
I'm told there's a usury law, which allows the banker not to overprice in terms of the interest.
Is it loans or the loans on the...
In terms of loans, as Roderick rightly said, we don't have interest rate caps
we are not doing
in Ghana, because the reason is that we don't have an avenue that provides the funding to the institution. You have a situation where an MFI that promises 10% because you want to attract investment so that you can trade with the investment. If I buy the money from the market at 10%, I will have to sell 10% plus my margin so that my margin can take care of my operational expenses so that I can survive. And I'll have to pay back where I purchased my money from. The banks are not readily available to support the microfinance institutions. Some banks are charging as high as 40%, 35% for the loans they give to the microfinance institutions. So you realize that who do we blame? Do we blame the microfinance institution? Do we blame the banks? Government have also not made available funding to the microfinance institution that we can borrow at a cheaper or lower rate and on lend to the poor. So you realize that the poor pays more because in terms of accessing credit from the banks, they don't have the...
That's my next question, muscle. Because the whole idea of this institution was to alleviate poverty. Yeah. Now, how do you alleviate poverty with this phenomenal, if I may say, interest rate? So has it made people poorer, or has it helped people to come out of poverty?
Yeah, it has the two sides of the coin. It has helped people, and it has also made people poorer. Let me tackle the poorer aspect. As I said, the microfinance companies are also business entities, and they play the financial intermediation role at the grassroots. Where they take their money from, they buy at a very expensive rate. If a microfinance institution walks to a bank, not all banks are willing to on-lend to the microfinance institution because they perceive the microfinance institution to be high risk. If they are high risk, then the interest rate goes up. A bank will want to on-lend to a microfinance institution at, let's say, 40%. You take this 40%, you're a microfinance institution. How do I trade with this money so that I can get back the 40% and offset my loan? You need to put your margins on it so that you can survive as an institution. Then the cost is transferred to the innocent client. So you could see that in terms of the blame, there are a lot of actors on the lines. The banks are to be blamed. Government also have to be blamed because government have also not provided the avenue where funding could be made a little bit cheaper so that the poor can access. So at the end of the day, the poor or low-income earners have to struggle and borrow at that rate. Two, they have no alternative. Because if they go to the banks where the rates are better, criteria, they don't qualify. So access becomes a limitation to the low-income earners, because when you go to the banks, the criteria they will spell out, you don't have it. So you have to turn back to the microfinance institution where you can get the loans at a faster time, and you can get it easy access to do your business. Some have borrowed at a very good rate with the microfinance institution, because when you look at the average interest rate, it's about 5% per month, because they run microfinance institution normally. Basically, a lot of them run on the flat interest rate method. The credit unions are running on the reducing balance.
So who's got a better repayment record, the mainstream banks or the microfinance, in terms of loan? Who's got better repayment?
It depends. We have some microfinance institutions that are doing better in terms of repayment than a universal bank, and we have some that are also performing very poor.
I don't know if I put the question right. I'm talking about repayment of loans that they've given to clients. You know, the banks always report, bad debt, and we can't reclaim that loan. We can't. Yeah, and I think they're around about 20%. Yeah. So what's the percentage of the microfinance in terms of loans
that go back? It's between 25 to 30%.
So not too far. Not too far. So whatever you do, 20% not going to pay.
For me, I would say the microfinance, they are doing very well, because you're looking at where we're dealing with the risk the banks fear.
Because you go and he's moving his kiosks and that's it.
Where the banks fear to trade, that's where we are trading.
Let me bring Roderick in here. Roderick, I mean, you've done a lot of research about this. Has it done more good than bad, or more bad than good, this institution?
Well, I think they have done more good than bad. Okay. More good, first of all, from the access points, creating assets and giving them opportunities to be part of the financial system. And then the other part is most of the clients would have the add-on, what is called the non-financial services, because a typical good microfinance would also look at improving the capacity of that client, because most of them that would come in, they come in necessarily with low education, low financial management. But once you are going to create financial assets for them, you need to be able to school or monitor them to be able to utilize what needs to be done. But I think on that score, I want to say that it's important for us to do this and do it well, because my observation in the sector is that if we don't take it soon, microfinance will become an elite. It would go for the elites in society as well, because even as we speak now, we have clients, different kinds of clients when it comes to the microfinance sector in Ghana. We have people who necessarily are contractors but are taking loans from microfinance institutions. Mm-hmm. There are people of all categories of classes, for instance, because of the turnaround time. So if we don't put it together, we may be increasing outreach, but necessarily we'll be missing our targets. One way of doing this to know that you are necessarily targeting the poor is also to look at the values, the average loan sizes on our books. In Ghana, averagely, you are going to get people giving us as much as 1,000 Ghana cedis. So you ask yourself, which poor person is managing 1,000 Ghana cedis? So even looking at the figure, you are able to know the characteristics of that client. So it's important for us to know our targeting and do it very well. Other than that, we would have the industry in the next 5-10 years acting just like the traditional banking system, neglecting the target groups.
In a minute and a half, so what's the way forward so we minimize the number of closures and upsets that we're going through? What would be the way forward?
I have outlined 6 key things that microfinance institutions need to look at. I mean, this year, for instance, most of them have boards, but they are not active. Governance is a problem. 2, sustainability and outreach. Don't just grow in number. Don't just grow your staff. Don't just grow in branches. Look at your sustainability, because any amount of step you take is a cost. So you should find out if that step can be able to cover the costs. Then you're looking at efficiency. Most of the costs that we pass on are not necessarily the actual direct costs. They are because of inefficiency. For instance, workload. How many staff do you have per micro client? Some of them overload their offices. Some of them are virtually doing nothing. One officer to about 5 people is a cost to you. And then we also need to develop the entrepreneurial capacities of the clients, because the more they excel with their enterprises, the better they are able to pay your loans, and the better they are able to increase their deposits. So they create a cash flow for you to survive. So if we're able to do some of these things, creating good systems, so that you can support your base, are the key things that we need to also look at.
Richard, you are in the heart of it. What's the way forward?
Yes, I'll build on what Roderick has come up with. The way forward is enforcement of the regulation by the central bank. Because the regulator, we all look up to the regulator. So in terms of enforcing and ensuring that we all work within the regulatory requirement, rest with the regulator, is to enforce full regulation. And 2, for Ghanaians to also understand the microfinance business model. We are trading, and the microfinance institution stands in the middle as a mediator. I take money from the public with the intention of also paying back something to the one I collected the money from. I need to trade with the money over a period of time we have agreed upon. So I let out a certain percentage. By the regulation, I can release 70% of the money I have taken from the public and keep 30% into a reserve with a bank. So the 70% is out there trading so that I can gain the interest and pay back what I collected from it. But most Ghanaians, as soon as they hear issues in the media, they all rush to the microfinance. We need our money. I tell you, no financial institution at a go when they have 40% of their clients walk into the banking or can pay their deposit liability. It doesn't work. Banking doesn't work in that way. So Ghanaians will also have to understand the microfinance model. Then 3, clients who also take loans from the institutions. Some intentionally do not pay. If we are all doing, fulfilling our commitment to these institutions, they will live long. Then the 4th thing I will add is capacity, as Roderick said. The microfinance institutions, people go in to microfinance because it's perceived to be profitable. They end up regretting that, I thought within 1 year I could make 1 million Ghana cedi, but it's not what I thought.
Well,
because then they are in a stack.
Thank you very much. Thank you very much. Talking from my immediate left is Richard Amening, Executive Secretary, Ghana Association of Microfinance Companies, and Roderick Ayer, microfinance consultant, who has written the book and Comprehensive Microfinance in Ghana. Get it, read it, and understand it, because the whole thing is that people are going in with very, very little experience, just thinking that I'm just in there to make profit. Yes, it is, but I think there's a lot of technicalities before the profit comes. Thanks for watching. And as I always remind you, on Thursday, tune into Joy 99.7 FM or My Joy Online at 2:05 p.m. and listen to a piece I call That's My Opinion. And tomorrow I'm saying that while we were busy talking politics, ... so many things happen. Now, if you want to know what happened while we were busy talking politics, you have to tune in. My name is Nana Sakwa, and as I say, tomorrow we're back to do it all over again.